Bank consolidation, lessons from JPMorgan Chase's acquisition of First Republic Bank. The banking industry has been in the spotlight recently due to the acquisition of First Republic Bank by JPMorgan Chase, which came after the bank experienced financial difficulties and was taken over by the Federal Deposit Insurance Corporation, FDIC. The acquisition, which included the assumption of $92 billion of deposits and the acquisition of a substantial majority of First Republic Bank's assets, has raised questions about the state of the banking industry and the potential impact of such acquisitions. The acquisition of First Republic Bank by JPMorgan Chase is not an isolated event, as it comes after the collapses of Silicon Valley Bank and Signature Bank earlier this year. These failures threaten to spark more bank runs, but proactive measures taken by lenders and regulators have helped to stabilize the situation. However, First Republic Bank was an exception, as it experienced greater deposit pressure than expected. The banking industry has faced numerous challenges in recent years, including low interest rates, increasing regulatory scrutiny, and the emergence of new technologies that are disrupting traditional banking practices. These challenges have led to increased consolidation in the banking industry, with larger banks acquiring smaller ones to gain market share and achieve economies of scale. While some argue that consolidation in the banking industry is necessary to remain competitive in a rapidly changing landscape, others worry that it may lead to reduced competition and increased systemic risk. Critics also argue that consolidation may lead to a reduction in consumer choice and a lack of diversity in the banking industry. Proponents of consolidation in the banking industry argue that it can lead to increased efficiency, improved economies of scale, and reduced costs. This can translate into lower prices for consumers and increased profitability for banks. Consolidation can also lead to increased investment in technology, which can help banks stay competitive in an increasingly digital world. However, there are also potential downsides to consolidation in the banking industry. Critics argue that it can lead to reduced competition, which can translate into higher prices for consumers and reduced access to credit. Additionally, some worry that consolidation may lead to increased systemic risk, as larger banks become too big to fail and pose a threat to the wider financial system. Despite these concerns, consolidation in the banking industry is likely to continue, driven by a range of factors including changing consumer preferences, regulatory pressures, and technological advancements. The impact of this consolidation is likely to be felt across the industry, with smaller banks struggling to compete and larger banks gaining market share. In response to these challenges, smaller banks may need to focus on niche markets or develop innovative new products and services to remain competitive. This may require investment in new technologies, partnerships with fintech firms, and a willingness to embrace change. Regulators may also need to adapt to the changing landscape of the banking industry, ensuring that they remain vigilant to potential risks and taking steps to promote competition and prevent the emergence of too-big-to-fail banks. Overall, the acquisition of First Republic Bank by JPMorgan Chase is just one example of the ongoing consolidation in the banking industry. While consolidation may lead to increased efficiency and reduced costs, it also raises concerns about reduced competition and increased systemic risk. As the industry continues to evolve, it will be important for regulators and banks alike to adapt and find new ways to remain competitive while protecting consumers and the wider financial system.